could be different forms by which it is done. That is what we come to know. So on the one hand, we saw the buyback and redemption of preference share capital and the buyback of securities. This is what we saw. What is common to both of them? Capital is reducing. It's a reduction of capital. Of course, not an unhealthy trend. Redemption of preference share capital is basically done so that the same preference shares can be issued to a new series of shareholders. Buyback of securities is commonly resorted to in the case of overcapitalization or over liquidification. When a company feels that it is overcapitalized, it doesn't require that much of capital. You can reduce your longest term liability. There are different types of long-term liabilities. For example, I can take a bank loan for 7 years, a housing loan for 15 years. Like that, for a company, the longest term loan, strictly speaking, you can't use the word loan there or a liability there. That is the equity share capital. So the company's Amendment Act of 2006 decided to bring in some kind of a respite to the irredeemability of equity share capital. They said we will make it indirectly redeemable. But then when the provision was brought in for equity shares, they said why not bring it for the other securities also. So buyback and redemption basically reduces your capital. Whereas issue of shares will increase the capital. Increase in the sense, increase the issued capital. I hope you remember the staging of capital in the balance sheet: authorized, issued, subscribed, called up, and paid. Out of the authorized capital, after a company has come into existence, when further amounts of capital are issued as a funding mechanism, that is where issues of capital after the first IPO or FPO is what we are dealing with. So you need to have a prospectus, you need to appoint an issue management team, you need to submit the prospectus to the regulatory authorities, you have to cross the hurdle called minimum subscription, wait for at least 3 days, refile a copy of the prospectus, and then make it up. That is something we have seen. Now, we come to other issues of capital where the procedure is the same. Appointing an issue management team if necessary, if it's a listed company. So what are the additional methods by which the authorized capital can be released to the public? We are coming to 4 of them now. In that order, I will be taking up the rights issue first. A rights issue of shares, unless stated otherwise, let us imagine equity shares. Then comes the bonus issue. Then the concept of sweat equity and ESOPs. I am coming to 4 methods by which authorized capital is released to the public. And again, unless I specify otherwise, any company, private, unlisted public company, listed public company. So basically, we are going through the Companies Act 2013 provisions with respect to these 4 special types of issue of capital. Apart from an IPO and an FPO, which we saw in our previous chapter. A rights issue made by a jury. A rights issue is what we saw in the creating certain intellectual property assets to the company. ESOPs is for employees. And there's a general assumption that the number of employees would be less than the number of shareholders in the company. Not always. Well, I just made a general statement. There's no linkage between the two, but then look to that linkage is necessary for the purpose of comparing these two. So in the case of a company like Reliance, which recently went in for a rights issue, The rights issue itself is large. The number of employees of Reliance is definitely much less than the number of shareholders. So I'm coming to these four specific types of issue of capital and coming to the Companies Act complications with respect to that. What are the additional conditions you have to comply with? Additional conditions in the sense, apart from our usual prospectus, minimum subscription, refiling a copy of the prospectus, allotment, apart from all that, that applies even to this. Apart from that, what are the other technical aspects? Because we should remember that these are all subsequent issues of capital or further public or private offers. Further public offers or further private placements by a company. So whenever a company makes an issue of shares which is exclusively earmarked for a category of investors, that is what you call a private placement. So strictly speaking, in the language of SEBI, these four are private placements made by any company. A private company can make only a private placement. So if a public listed company makes any of these types of issues, technically it becomes a private placement by a public company. So I hope you get the difference between what we did so far in this chapter and what we are now going to do. Four specific types of capital issues. Just give us some heading. Provisions relating to specific types of capital issue. Provisions relating to specific types of capital issue. Okay, just give it an introduction, then we'll go to them one by one. After incorporation, and the first issue of capital, after incorporation and the first issue of capital by a company, after incorporation and the first issue of capital by a company, comma, authorized capital may be released or issued. Authorized capital may be released or issued by different methods. Okay, so after incorporation and the first issue of capital, the authorized capital may be released or issued through different methods of issue. Okay, full stop. Generally, these methods constitute private placement models. That is, these issues, are generally generally pointed to a specific class, are generally pointed to a specific class of shareholders, of shareholders. Okay, so that is what we see as common to all the four, whether it's a rights issue or a bonus issue or a sweat equity or an ESOPs. Basically, what is common to all of them? They are all designed or they are all directed to one particular segment of shareholders. It is either your existing shareholders or the employees of the company or the management of the company for specific purposes. Okay, so apart from whatever contents or the technicalities that we are taking up now, remember the procedure continues to be as in the case of the previous chapter. Okay, in the next slide, in the following issues, comma, the procedure, open brackets there, the procedure, open brackets, especially if it is a listed public company. Within brackets, especially if it is a listed public company. Close brackets. Continues to be the same. Continues to be the same as described in chapter 4. As described in chapter 4. Except for minor circumstantial changes. Except for minor circumstantial changes. Okay, so what is it that is common to all the four that we're going to take up now? They're all methods of increasing your capital. You are releasing a part of your authorized capital to the public. Secondly, in all these cases in accountancy language, share capital account is credited. What varies is only the debit part. Number 3, they are all further public offers. They can never be an initial public offer. Number 4, they are all methods by which a company releases capital to a specific segment of shareholders or stakeholders. So to that extent, there might be a change. For example, we saw in the types of prospectus that in the case of a rights issue, there is no point in giving them a full-fledged prospectus, because a rights issue is offered only to the existing shareholders. So why do I have to give them the details about the company, its profile, its background, its history, or that of its promoters or directors? Not necessary, because they already know it. So what is relevant to be intimated to the public in a rights issue is only the purpose, the objects, the terms and conditions of that particular issue of shares. Let me check your memory. Let me try to see if you remember what we did in our previous chapter. What is technically the name of the prospectus which is issued by a company for a rights issue? I repeat my question. When a company makes a rights issue, what is the prospectus called? We saw different types of prospectuses. We saw an abridged prospectus, what do you call it, shelf prospectus, an information memorandum, a deemed prospectus, a red herring prospectus. Yes, perfect. It is the information memorandum. The information memorandum is not a different type of prospectus. This is what we decided. We said it is a prospectus only. Instead of calling them types of prospectuses, you should call them types of circumstances or types of issues in which a prospectus is issued. For example, shelf prospectus, banks or financial institutions, information memorandum, rights issue, abridged prospectus, issue opening advertisement, red herring prospectus, book building issue, deemed prospectus, any document which may not be in the standardized form as given by section 26. So the first one that we are going to take up is the rights. A rights issue is dealt with by section 62 of the Act. A rights issue, there's a specific reason why it is given that name, rights. But otherwise, a rights issue is also called a preemptive issue or a preemptive right, or the right of preemption. Rights issue, preemptive right, or the right of preemption, it might be called. Now, the logic of a rights issue, the reasoning behind the rights issue is very simple. When a company makes an issue of share capital out of its authorized capital, it is necessary, it is mandatory that the offer must be made to the existing shareholders first. That is why it is called a rights issue. The right of the existing shareholders of a company, the equity shareholders, to be offered a fresh issue of shares when it is made by a company is called a rights issue. So whenever a company releases out of its authorized capital shares for the second, third, fourth, fifth, sixth, subsequent time, it must be first offered to the existing shareholders. We'll take an example. Let us say the authorized capital of a company is 1 crore. It was issued the first time for 35 lakhs. 35 lakhs was issued to the public. Now it is making a further public offer, let us say 2 years after the previous issue. So the issue 2 is going to be of 40 lakhs. This 40 lakhs, when you issue it, the Companies Act, section 62 says must be offered to the existing shareholders first. Only if they say no, they don't want it, you can actually go public. Section 62 of the Companies Act says that whenever you release out of your authorized capital fresh issue of shares, it must be offered to the existing shareholders first. And the logic or the reasoning is very, very simple. It is common sense, it is not company law. It is only to ensure that the existing shareholders who are contained in this issue should not lose their voting rights. Let us say 35 lakhs of share capital was issued to about 2,50,000 shareholders. So now, for a capital of 35 lakhs shown in the balance sheet, The company has 250,000 shareholders. It's a public company. When 40 lakhs is released today, 2 years later, and I issue it to a completely different public population, I will have another 3 lakh shareholders coming in, making the total number of shareholders to 5,50,000. You can imagine what will happen to the voting rights of the shareholders comprised in this 35 lakhs. Fundamental rights. We'll be coming to this in our next chapter. What are the rights of shareholders or members? The very first right of a shareholder is voting rights. So I can't let a company or the board of directors of a company to dilute the voting rights of a shareholder by inviting the general public when you already have existing shareholders who have been attending meetings, exercising voting rights, passing resolutions. This is why we chartered accountants, company secretaries, we call a rights issue as an anti-dilutive measure. Nice word. In other words, this provision of the Companies Act, given by section 62, is an anti-dilutive provision. That is, it is a provision which prevents dilution of voting rights by shareholders or of shareholders by the company or the board of directors. See, I'm just reconciling two different objectives through this provision. A company has already released 35 lakhs of share capital. Today it is releasing 40 lakhs of share capital. When this 40 lakhs years, the directors and the shareholders have become pretty familiar with each other. They have already developed a system by which this, but at the same time, on the other hand, I need to protect the voting rights of the existing shareholders. So section 62 has to tie up these two distinctive objectives. That is why the provision. So section 62, which deals with the rights issue, which is also called the right of preemption or the preemptive right, only says that whenever a company releases capital out of its authorized capital in future, it must be offered to the existing shareholders first. And the objective is to ensure that voting rights, when you say voting rights, therefore definitely I'm talking about equity shares. Preference share capital does not give the holder voting rights, except in two exceptional circumstances. So we are talking about equity stock or equity shares. So it must be offered to the existing shareholders to ensure that their voting rights are not disturbed. And the rights issue is always made in proportion to your existing holding. It might be in some proportion like 2:5. That is 2 for every 5 shares held, 4 for every 3 shares held, 7 for every 5 shares held, 4 for every 6 shares held. So if I am a shareholder having 50 shares, let us say, if the company is offering it to me in the proportion of 2:5 or 2 for every 5, I will get 20 shares. So my shareholding will become 50 plus 20, 70. But if this issue is given to somebody else, that 20 shares will go to some foreigner. I mean, somebody who's alien to the company, some member of the public. And he will start enjoying the voting rights which I should have got. So that is a rights issue. By logic, by nature, the provision says it must be offered to the existing shareholders. Now, coming to the names, preemptive right, beautiful words. Preemption means, pre means before. Empty means ruled out. Or empty means not for you. So the right of preemption means even before the capital issue is made, the public are ruled out in favor of the existing shareholders. That is why it is called the preemptive right or the right of preemption. So the existing shareholders of the company have a right to preempt the public when a fresh issue of capital is made out of the authorized capital. So I'm just explaining the names, how the names came. Rights issue, preemptive right, or the right of preemption. This is the logic. Now, once you know the rule, like we've been doing for all the other provisions, once you learn it, then play with it. Learn the law, play with the law. Okay, so take down this first. Number one, rights issue. I'll come to that. 1 minute. Number one, rights issue. When a company issues capital, out of its authorized capital, when a company issues capital out of its authorized capital, comma, the fresh issue must be offered to the existing shareholders first, that is before offering the same to the public. Before offering the same to the public. Okay, full stop. The right of a shareholder, to be offered, a fresh issue, first, is also called the preemptive right, PRE-EMPTIVE, is also called the preemptive right or the right of preemption or the right of preemption, PRE-EMPTION, or the right of preemption. Okay, we'll stop in the next slide. The objective. behind the provision, the objective behind the provision is only to ensure, the objective behind the provision is only to ensure that the voting rights, of existing shareholders, is not diluted, and hence the provision relating to a rights issue is also technically called an anti-dilutive provision. Is also technically called an anti-dilutive provision. ANTI-DILUTI, anti-dilutive provision. Okay, so otherwise you will see that I am a shareholder in a company, I am holding 50 shares. Let us say by holding 50 shares, I have a 1/18th voting power, a minuscule voting power. Or holding of that 50 shares, 50 equity shares gives me 1/18th voting rights. Now, if the 20 shares which I was supposed to get is given to somebody else, my 1/18th might become 1/20th, 1/24th, 1/28th. But when an issue is made to the existing shareholders, look at the beauty. Everybody's shareholding goes up in the same proportion. I had 50 shares, my holding becomes 70 shares. Another person had 25 shares, it will go up proportionately. Another person having 35 shares, it goes up proportionately. So everybody's shareholding goes up in the same proportion to a new level. That is a rights issue or even a bonus issue. So it is always offered in proportion to the existing shareholding. Now, this is the provision. Section 62(2) says, suppose an issue is made like this to the existing shareholders, if the shareholders pass a special resolution to the effect that they are not interested, then the board of directors can go public. Naturally, it's a fundamental right. I am not forcing a rights issue on the existing shareholder. If there's a shareholder who says, I'm not very interested in voting, I don't mind my voting rights going. I just want my dividends. I just want my long-term and short-term capital gains. Voting is secondary for me. There might be, let us say, about 40-50% shareholders like that. And this is the answer to the question that came up some time back. How did rights issue of Reliance get oversubscribed? I'm coming to that. For that, you need to understand this. So when the shares are offered to a shareholder or to the shareholders en masse, so I'm now giving it a macroeconomic perspective. All the shareholders of the company get together and pass a special resolution that the board of directors can go public. Either the existing shareholders are not interested in their dilution of voting rights, it's okay, they don't mind it, or they also feel that we need a new fraternity of shareholders. Then they can pass a special resolution and direct the board of directors through that resolution to issue it to the public. Even otherwise, an ordinary resolution is enough. So, number one, preferably a special resolution. A special resolution will allow the board of directors to go public. Whenever you issue the public, we technically use the word going public, a company going public. So a special resolution will enable or empower the board of directors to go public. Even otherwise, an ordinary resolution is sufficient to go public, provided it is also accompanied by central government approval. So what does that mean? At least an ordinary resolution is necessary for the purpose. If a special resolution is obtained from all the shareholders, the board of directors can boldly go to the public. But if it is only an ordinary resolution, then the company will have to seek central government approval in order to make the issue to the public. Which means that if 50% or less of the shareholders only agree to going public, the company cannot go public. The board of directors cannot go public. And it becomes mandatory, it becomes the duty of the directors to offer to the existing shareholders. So these two are completely a macro perspective. Macroeconomics, but it's now macro. Now I am coming to the micro perspective. So let us say the company fails to get a special resolution or an ordinary resolution, or getting an ordinary resolution, central government doesn't approve. Then what happens? You have to offer to the existing shareholders. But then, among the existing shareholders, there might be some who say we don't want it. You go public. Whatever you need to give us, you give it to the public. We are not interested in additional shares of the company. And like this, when the shares reach the public, there could be oversubscription. So oversubscription in a rights issue arises when the entire body of shareholders has not accepted. A section of the shareholders have allowed the company to go public. So at the macro level, where I'm talking about all the shareholders of the company, you need either a special resolution or an ordinary resolution accompanied by central government approval. Where you can't get them, like a flow chart. Special resolution, yes, go public. No special resolution, ordinary resolution, central government approval obtained, yes, then go public. Otherwise, offer it to the existing shareholders. And when it is offered, let us say about 30% of the shareholders are not actually interested. It's the remaining 70% who are interested. They have passed a resolution. Or the 70% have refuted it, refused permission to the board to go public. The remaining 30% don't mind, but they are only 30%, so they are the minority. Now, as a shareholder, so I have 2-3 options. Number one, passing a resolution, I have not passed a resolution, a special resolution not got passed. So I am offered 20 shares for my 50 shares. I can take it and pay the company for it. Option number one. Option number two, I can tell the directors, I am not interested. You can issue those to the public. That is one possibility for an oversubscription. Option number three, which is more important, more dangerous. I can tell the directors, I don't want it, but give it to Mr. X. That is called renunciation. Renunciation of our rights. So I'm not telling the board of directors outright that I don't want it. I am adding a rider to it. I don't want it, but give it to X. Now the board of directors will be bound to give it to X, and X will pay the company for the shares. And for having renounced my rights to Mr. X, I will get a consideration from Mr. X, which has an income tax complication. Section 55 1B of the Income Tax Act. You study this in capital gains. ആ കിട്ടുന്ന consideration taxable ആണ് without any cost of acquisition. So I take a consideration from Mr. X for renouncing my rights to him. Why? Because that will make him in my same position now. Next time when the company makes a rights issue, he can accept, reject, or renounce. So to bring X into my shoes, I take a consideration from him. So from the macroeconomic point of view, it is either a special resolution or an ordinary resolution coupled with the central government approval. So if none of them can be obtained and the shares had to be offered to the existing shareholders, then individually the shareholders can accept, reject, or renounce the rights in favor of another person who need not be a member of the company. 62(2) says that. Which means you can renounce it to another existing shareholder also. I'm a shareholder holding 50 shares, there's another shareholder holding 75 shares. I can ask the company to give it to him. He is more interested in voting rights than me. So you give it to him, my shares. So from the macro and the microeconomic perspective, how the rights issue affects the existing shareholders is what we have seen. Okay, now you have written the basic provision. Now come to below that, 1. However, if approved by a special resolution, of the company, if approved by a special resolution of the company, the issue may be made. The issue may be made to the public. The issue may be made to the public without offering to the existing shareholders first. Without offering to the existing shareholders first. Okay, we are going down in the size, macro to micro. 2. If approval is obtained, of the company, by an ordinary resolution, if approval is obtained of the company by an ordinary resolution, such approval shall be accompanied by Central government approval. Central government approval also. Central government approval also. In order to enable the company, to go public. In order to enable the company to go public. Okay, so effectively what are we trying to say there? A special resolution is equivalent to an ordinary resolution plus a central government approval. Moral of the story number one. Moral of the story number two, you need at least an ordinary resolution. If less than 50% of the shareholders' population only agrees, not sufficient. You'll have to give it to the existing shareholders. Okay, 3. In the absence of the required approval, in the absence of the required approval, comma, in the absence of the required approval, comma, the offer of fresh issue, shall be mandatorily made. The offer of fresh issue shall be mandatorily made to the existing shareholders, who may accept by making payment for, comma, or reject or renounce, R-E-N-O-U-N-C, or renounce the issue, in favor of another person, who may or may not, be a member of the company. Another person who may or may not be a member of the company. Which means as a shareholder, I have a right to announce it to any person outside also. It might be to another member also. I can renounce in favor of anybody. Okay, so certain technical terms used here: preemptive right, right of preemption, go public, mandatory offer to existing shareholders. These are all the catchwords here. Accept by making a payment for the shares, rejecting a rights issue, or renouncing the rights issue in favor of another person who need not be a member of the company. I'll put it that way. Now, to show you the effect of this rights issue in real life, to give you a semblance of how things are going on in the real time life of a public listed company, I want to take up an example here. I want to ask you a question which I don't remember if I've asked you before, but then still I don't mind it. Even if it has been asked before, even if it is at the cost of repetition, I want to understand this better. I am a shareholder in a public company holding 25% share capital. I'll make it 26. 26% of the equity share capital I am holding individually. Can you guess or imagine what power I carry with respect to decision making? Individually, alone, without anybody else's help, or without the shareholding considered of anybody else in my family, I alone am holding 26% share capital. Equity share capital in a company with voting rights. In a public listed company, you know the power I carry? In the language of a company secretary, this will assist the shareholder to block a special resolution. You need a 75% majority for a special resolution. So if I'm holding 26%, all the others together are holding only 74%. If the articles of the company provides for voting by number of shares, they are not powerful enough to get that special resolution passed without my help. He used the word block. So, a shareholder holding 26% of the share capital voting rights in a company can block a special resolution. Similarly, if a person is holding 50% of the equity share capital, he can block not only a special resolution, he can also block an ordinary resolution. Because there you need 51% majority. 50-50 is not good enough. So you have one person holding individually 50% of the paid up equity share capital, he can block any resolution. Look at one step further. A person holding 75% share capital, or even before that, suppose I take 51%. I just go in the order. One person is holding 51% of the equity share capital. What is the power he has? He has this power, plus he has this power, plus he can pass an ordinary resolution without the help of any other person. He can block a special resolution. He can block an ordinary resolution, or he can pass an ordinary resolution by himself. Then comes the climax. 75% of the equity share capital, one man holding. He can do all this, plus he can pass a special resolution. He is very powerful. There are some people who are fanatic, who are crazy about increasing their shareholdings like this. And believe me, rights issue is the only method by which you can do it, especially in the case of a large-scale company, like a public listed company. How much can you buy or sell from the open market after all? In a company having 3 lakh, 4 lakh shareholders or capital in crores, one individual or a group influencing or acquiring that kind of a shareholding by small scale acquisitions in the stock market will take you a long time. It is infinity. Whereas in a rights issue, this becomes easy. Suppose I am a shareholder having 16% share capital today, and my target is this 75%. At least in the long run, I would like to get that and become the most influential person in the company. I can do this by waiting for rights issues. When a company makes a rights issue, provided it has to be offered to the existing shareholders, I go begging to every shareholder, if you are not interested, please renounce it in my favor. So just before a rights issue is being made by a company or it's being issued by a company, I request every shareholder, if you're not interested, give it to me, I am interested. And I go on acquiring. And that was at a consistent price. So slowly 16 will become 19.5. 19.5 becomes 24. 24 becomes 29. 29 becomes 37. So every rights issue, and through small acquisitions in the stock market coupled with that, a shareholder can increase his muscle power, bargaining power, decision-making power, voting rights. But then to prevent this, we have a SEBI regulation. It is called the SAST regulation. Just like ICDR, the SEBI SAST regulations. SAST is substantial acquisition of shares and takeovers. So we know one thing. One thing is clear here. The junction is 25%. Any person having SAST will apply only in the case of a listed company, therefore. Forget about all this for a private company or an unlisted public company. SEBI regulations will apply only to listed companies. We have seen this before. So, according to the SAST, it's also called a takeover hold. What's higher at your level? But then just showing you the preventive mechanism for this kind of a takeover. It's called a hostile takeover. A person silently creeping up his holding, and one day break the ceiling of 75 and become a very powerful shareholder. Believe me, there are shareholders like that. So according to this regulation, whenever a person holds 25% share capital, once he comes to 25%, after that, if his shareholding increases even by 1%, he can increase it only by making an open offer to the existing shareholders. You can't do it silently, creepily like that. So let us say my shareholding has come to 25%. 25% is called the trigger point. And the company is making a rights issue or a fresh issue, or I'm going to buy some shares, by virtue of which my shareholding is going to go up. I have to make an open offer. As a shareholder, I will have to inform the shareholders I am going to acquire another 1,50,000 shares. That is called a public announcement. It is mandatory. Even otherwise, if you're holding a proportion of share capital which is less than 25%, if what you are proposing to acquire now is going to make it 25% or more, you have to make a public offer. Public announcement to the shareholders that you are going to acquire. And then if they agree, then there's no problem. The only thing is I don't want a shareholder, according to the SEBI, I don't want a shareholder to do this stealthily, silently, moving without the knowledge of the others. One fine morning, this fellow will break the ceiling, cross 26%, 50%, 75%. And then only the others realize, oh, everybody. That is where SAST comes into picture. Besides, Companies Act also has brought this in the form of scheduled disclosure. If you remember the way we started with this chapter, I told you that there is one particular disclosure requirement where a company will have to disclose the top 10 shareholders. In the decreasing order of their voting rights. That is Companies Act's contribution for the other shareholders to identify that in the near future, these shareholders may break that ceiling of 25%. I still remember Wipro was the first Indian company to get listed on the New York Stock Exchange. And that was years back, maybe around 16, 17 years back. I remember when Wipro made an application to the New York Stock Exchange for listing. At that position, Mr. Azim Premji, Chairman Managing Director, was holding 76% share capital, equity share capital in Wipro by himself. That means so many lakhs and lakhs of shareholders together were holding only 24% of the equity share capital. Azim Premji has that kind of a management style. He does not delegate. He holds on to power. In business management language, we say his succession planning is bad. Narayan Murthy, on the other hand, Infosys, is the exact opposite. From the time the Infosys company was set up, he started looking for a successor. His succession planning. The day the company stood up on its legs, he realized that tomorrow, if I am not there, nothing should happen to the company. Azim Premji is the exact opposite. Narayan Murthy doesn't even have a designation in Infosys. He calls himself mentor. Not chairman, managing director, whole-time director, president, vice president, nothing. He is paid an honorarium for professional advice. He advises the company from outside. He is not even an employee of the company. And he is paid professional charges for advice. He tells the board of directors, I am there always. Whenever you need me, you tell me, I'll jump in. Until then, you manage the show. So where one person individually was holding 76% of the share capital, and you make an application to New York Stock Exchange for listing, that was the condition of the board. Within 15 days, he got his response from New York Stock Exchange. New York Stock Exchange told him, Dear Mr. Premji, you are holding 76% share capital of Wipro and you call yourself a public company. We can't understand how. In our opinion, you are a private company. However, all that apart, We will give you 15 days time. Bring down your 76% to anywhere between 25 and 30%. Otherwise, we are sorry to say, your listing application is rejected. And when Azim Premji gets this kind of a notice or this kind of a correspondence from the New York Stock Exchange, obviously, who will clap first? Very, very good. Government of India. Because the government of India does not have the guts to say that. I've been telling you time and again, in India, the public companies are actually glorified private companies. We don't have public companies in India districts of the world. All the companies that we have, which are called Fortune 500 companies, the elite companies, the top 10, 100, 500,000 companies, they are all family-run businesses like this. The tragedy of Indian economy. Public company in the real sense of the word, India. The company at the group holding up. There will be one company in which the promoters are holding 40%, 50%, 60%, 70%. The company becomes very profitable. Our profit uses to bear the company incorporating. I incorporate the chief company share capital, e company holding. Baki or promoters will hold. Public 26%, 25%, 20%, 18%, 10%. When you say public company, public should hold the holding, not the promoters and sister concerns or their family members, relatives. In my personal opinion, there should be a provision somewhere, somehow, that the general public must hold 75% share capital at least. General public, small shareholders, individual shareholders, banks, mutual funds, overseas corporate bodies, other than the promoters, or other companies in the same group. There should be a provision somewhere. I hope you agree with me. And there is only one small provision that could not even in the Companies Act, the Securities Contracts Regulation Act, SCR. There is a section 19(1) which somewhere talks about it. 19(1) decides upon the share capital of the company, how much the public must hold, minimum. For example, if a company's paid up capital is 400 crores, 400 crores or above, at least 25% the public must hold. Here in my provisions, the word public is the opposite of promoters and the promoter group. That provision is very ineffective for us. Which means this is not very difficult to happen in the real-time context. So what I'm trying to tell you is, the rights issue is the only method, the only feasible practical method for a shareholder proposing to dominate a company in terms of voting rights. He goes on acquiring in subsequent stages of rights issues and increases his present holding provided the others renounce the shares in his favor. So this rights issue is something that you have to connect with SEBI SAS regulations, SCR. There are so many others also playing a role with respect to them, but they are all too high for you. I hope you got the concept. So what is the rule? What are the exceptions? What is the purpose? And what is it that you are trying to promote or discourage? It is the dilutive provision. Rights issue section 60. By the way, have you written that? Go to your heading. Rights issue side section 62. Section 62 is what we are dealing with. Section 62 says every company making a fresh issue of capital out of its authorized capital shall issue the same to the existing shareholders. The purpose is to prevent dilution of voting rights. It should be anti-dilutive. It is an anti-dilutive provision. Now remember, this rights in the choice which is exercised by a shareholder of accepting, rejecting, or announcing is taken based on the market price of the shares. I will give you an example. Going back to my previous example, let us say the company is making issue of shares. You are issuing capital worth rupees 40 lakhs. Now this 40 lakhs, let us say, is in shares of rupees 100 each. Rupees 100 is the face value. Let us say the market price of these shares is rupees 190 each. Remember, rights issue is paid for by the shareholder. So if I'm accepting rights issue, if I'm accepting my 20 shares, I pay for it. Now the amount of the shares has to be paid by me. Major difference between rights issue and bonus issue. Bonus issue is free of cost from the point of view of the shareholder. Rights issue is paid for. Now a rights issue is always priced between these two. Let us say the issue price comes to rupees 135 each. Now this is the deciding factor for a shareholder to accept it, reject it, or announce it. If 100 rupee shares are issued at 135 and the market price of the share is 120, I say I don't want it. So forget the face value, that is anyway balance sheet value, the book value. A shareholder takes a call on accepting, rejecting, or renouncing based on a comparison of these two. The higher the gap between the issue price and the market price, the higher is the probability that a shareholder will accept it. Accounting Standard 20 issued by your institute, our institute, deals with this particular aspect, calling it technically TERFV, Theoretical X Rights Fair Value. It's called the Theoretical X Rights Fair Value, TERFV. This is a method by which we teach the shareholder whether to accept it or reject it. So I have 50 shares, going back to my previous example, for which let us say I have paid 110. So my holding is, the investment is 5,500. I have acquired my previous 50 shares at 110 each. Now I am getting 20 shares at 135 each. What will that come to? 2,700. Right? So I have a holding which has cost of investment. The cost of investment is 8,200. But at the same time, what will be the market price? The market price will be 70 into 190. So I will have to pay 2,700 today for having a market value of 70 into 190. What will that be? 13,300. 50 plus 20 into 190 is the market price today, but that can vary. That's very volatile. So on the date of the rights issue, the offer of the rights issue, this I'm paying 2,700 today. I have paid 5,500 before for an asset having a market value of 13,300. So 13,300 minus 8,200 is the premium I will get. But at the same time, if I refuse it or if I renounce it, I will lose that. So comparing the cost of the choice is technically called theoretical X rights fair value in accounting standard 20 on earnings per share. Right? So what I'm trying to tell you is that there's a professional technical method by which a shareholder decides when a rights issue is made. And remember, the board of directors knows this. So every rights issue is made because of a mandatory provision, a statutory provision, the company has to do it. But there are two methods or three methods of bypassing this. Two of them are macroeconomic ones. One is a microeconomic one. Get a special resolution passed from the shareholders, then you can go public. Okay, so this is how the rights issue of Reliance. Somebody was asking me this question some time back. How did that get oversubscribed? That is because of the proportion of rejections and renunciations. Let us say a company makes a rights issue and only 60% of shareholders are taking it. The remaining 40%, the shares are offered to the public. And that offer to the public becomes a further public offer. The company makes an announcement in the newspaper. So many shares are available. It is out of the rights issue. Our shareholders are not interested. Anybody in the public, and you can imagine. If a shareholder of Reliance says he doesn't want it, and the shares get offered to the public, what will be its price and what will be its demand? So the oversubscription is to the extent of a rights issue which is either rejected or renounced. Otherwise, I agree with you. If all the shareholders, imagine a theoretical situation where all the shareholders accept the rights issue, then there is no scope for oversubscription. So 2 shares for every 5, 3 for every 7, 4 for every 6, whatever be the proportion, you will be offered that. And the document through which the shareholders are intimated is called the information memorandum. Make a note in the next slide. A rights issue is offered. A rights issue is offered to the existing shareholders a rights issue is offered to the existing shareholders through the information memorandum. Through the information memorandum. Okay. Now suppose I go back and ask you the basics. Let us say you're a company secretary. I'm a director of a company making a fresh issue capital. Suppose I ask you, should we wait for minimum subscription? The answer is yes. If it is a listed company, should I have a lead manager to be issued? Yes. Should I wait for the 3 working days? Yes. So that is what I said. These are provisions which are apart from what we have seen before. But then there is one small change here. A rights issue can be kept open for not less than 15 days and not more than 30 days. Now we are talking the language of the Companies Act. Section 62 says, SEBI is silent on this. So a rights offer, a rights issue, I mean, you can't just leave it open. How long you're going to keep the issue open must be decided as anywhere between 15 and 30 days. Because it is to the existing shareholders. I don't have any member of the public involved unless renounced shares or rejected shares are being offered to the public. Okay, so on the next slide, a rights issue is kept open. A rights issue is kept open for not less than 15 days, for not less than 15 days, and not more than 30 days. So all other provisions will continue to apply as it is. Minimum subscription, appointment of a lead manager, opening of subscription lists, resubmitting a copy of the information memorandum. The information memorandum has to be given even to the registrar, even to the stock exchanges, in the case of a listed public company. So all the other conditions applicable to the procedural provisions are the same. These are the substantive provisions. Okay, so that is the concept of a rights issue. Very, very important, very, what do you call it, relevant from the practical perspective. Now I'll take a break, or we'll take a break for about 10 or 15 minutes. I'll just have a cup of tea and come back. But then during the break, I want to leave you off with a question. Think it over. I'm asking you a question which was asked in one of the question papers. There is a listed company of which one particular shareholder is a company. Okay, there is a company, let us say AB Limited is a public company of which CD Limited is a shareholder. CD Limited is holding 30% of the share capital in AB Limited. AB Limited makes a rights issue, and this rights issue is offered to all the other shareholders except CD Limited, on the ground that CD Limited is already holding 30% of share capital, so they need not be offered further shares. Is that okay? In other words, can rights issue be refused to a shareholder on the ground that that shareholder is already holding a substantial portion of the issuing company's share capital? Think it over. We'll continue after a break. Okay? Is not of the company. So any ground, no ground is valid where a company refuses to make an offer of rights issue to a specific shareholder or a class of shareholders. The rights issue is it's an issue of capital made across the board. All the shareholders of the company have the preemptive rights. You cannot select some, or you cannot ostracize some. Okay, so make a note of that. Note an offer of rights issue must be made an offer of rights issue must be made to the general class of shareholders to the general class of shareholders and any of them cannot be avoided on any ground open brackets example already holding a substantial portion of capital of the issuing company comma, etc., and close the brackets. Okay, so it is a uniform offer made to all the shareholders of the company first. Then comes the question of a special resolution, ordinary resolution, central government approval, accepting, rejecting, renouncing. So all this comes up only after the preliminary requirement of the section, that the stakeholders, the interests of all the stakeholders must be uniformly complied with. And on the other hand, a shareholder cannot even tell the company, whenever you make a rights issue, don't worry about me, you offer it to the others. You can't do that. It is a fundamental right of every shareholder to be offered a rights issue. Now, another particular aspect is, let us say, if the issue is open for 15 days, we decided it is anywhere between 15 days and 30 days. Not less than 15 days and not more than 30 days. A rights issue is open, the offer is open for that time. So let us say a company has the bare minimum, 15 days. Information memorandum says the rights issue is open for 15 days. Now, after 15 days, on the completion of the 15 days, if a shareholder does not talk, if a shareholder does not convey his acceptance, renunciation, rejection, etc., it means that he has rejected it. And that will go to the public as per the discretion of the board. So this is not a case where silence amounts to speech, Indian Contract Act. The Maunam Samaram concept, the Indian Contract Act, doesn't work here. So if the shareholder keeps quiet after the offer is made to him for 15 days and he doesn't accept it, then this will go to the public. Okay, so every shareholder is expected to convey acceptance or rejection or renunciation if that special resolution or ordinary resolution of central government approval has not been obtained. Okay, so that we call this as note 2. Note 2. Where a shareholder has not conveyed his acceptance, comma, rejection or renunciation or renunciation to the company within the period of time specified in the information memorandum comma, it is a deemed rejection. It is a deemed rejection by the shareholder. It is a deemed rejection by the shareholder. Okay, which means indirectly that if you are rejecting it, you can afford to keep quiet. If you are accepting it or if you are renouncing it, that has to be conveyed or expressed to the company. Now remember, any of these can be done in part also. Going back to my example of a shareholder holding 50 shares who's offered 20 shares, I can accept 10 and renounce 10. Or I accept 5, renounce 10, reject 5. You can do it in proportion. So the number of shares offered to a shareholder under a rights issue or a rights offer can be accepted, rejected, or renounced, partially or wholly. So this is the concept of the rights issue or the preemptive right or the right of preemption under section 62 of the Act. Okay, so if it is a listed company, this will also be governed by the SEBI ICDR regulations. ICDR also prescribes for certain conditions in the case of a rights issue. For example, there is a condition in the ICDR which is too high at your level, that if a company which has announced a rights issue cancels it after making the announcement, then it is not entitled to listing on any stock exchange for the next 12 months. What a serious consequence. So if an announced rights issue is cancelled subsequently, that consequence is also provided for by the ICDR, but the Companies Act doesn't provide for it. So under the Companies Act, these are the provisions, the basic provision, why it is there, the concept of the offer open period, the concept of a deemed rejection, and the right of a shareholder to accept it, reject it, or renounce it. Okay, so this was the first of our special types of issue. Again, I repeat it, you've already written this or mentioned this before. Other provisions relating to the procedure will apply to all of them. Whether it's a rights issue or an IPO, minimum subscription, lead manager, so subscription period, all that continues to be the same if it is a listed company. Otherwise, SEBI will not apply, the ICDR is not required to be followed. Okay, now come to the second, bonus issue. The first was a rights issue. Now it is bonus issue. Fundamentally comparing it with the rights issue. I told you a rights issue is paid for, it is not free of cost. When a company makes a rights issue and a shareholder accepts it, everything goes smoothly there, the shareholder pays the company for it. In my example, that's 135 rupees. Face value 100, market price 190. Offer price to the shareholder, because it is to the existing shareholders, they are given a concession or a discount to market price. We saw before that a company cannot issue shares at a discount. That discount is discount at the face value. You can't offer shares to any section of the public, whether on a private placement basis or a public issue basis, at a discount to face value. You can discount it in market price, especially for employees, sweat equity, rights issue like this, bonus issue. Okay, so the first aspect about a bonus issue is that it is free of cost. Technically, in accounting, a bonus issue is also called the capitalization of reserves. Capitalization of reserves or profits. That means a bonus issue is funded internally. In a rights issue, what is the journal entry you pass looking at it from accountancy perspective? Cash or bank account debtor to equity share capital. Here, equity share capital is credited. What is it that is debited? It is the reserves. So, any of the reserves which are otherwise available for dividend distribution may be capitalized for this purpose. So that would include the debit balance, the credit balance in your P&L account, the reserve fund, a general reserve, or these are all liquid reserves, free reserves. Any of them can be capitalized for issue of bonus shares. What is that last one that I'm looking for? Anyone? The reserves which may be capitalized. The reserves which may be debited. Very good. Securities premium account. Again, there's one more. There is one more reserve which can be utilized for the payment of or for the distribution of bonus shares. All your liquid, these are all your liquid reserves. This is something which is specifically prescribed for by the provision, which is the other reserve which is used. Actually, that is meant for only this. Securities premium account can be utilized for various other purposes, include issue of shares as fully paid up bonus shares to shareholders, which is the other one I'm referring to here. Very nice. That is a CRR. The capital redemption reserve account is nothing but taking a bottle of water from the lower rack of the refrigerator and putting into the freezer. Putting into the freezer means it becomes capital. Capitalization of reserves indirectly means solidifying something that is liquid. Liquid I the reserves of paisa. So any of these liquid reserves can be used. The other is balance the P&L account or free reserves which are otherwise available. So these are the ones which are used, utilized for distribution period. I told you the last time, the problem with the word utilization. Accounts the parayan edupa. അല്ലെങ്കിൽ കമ്പനിയിലോട് പറയാൻ എളുപ്പമാണ്. Utilize this for this. ആ യൂട്ടിലൈസേഷൻ ഒന്നാമത് കാശ് വേണം, രണ്ടാമത് ഒരു ജേർണൽ എൻട്രി ചെയ്യാനായിട്ട് വേണം. You remember my concept of expenditure being two-pronged. Every expenditure requires profits or capital and cash. There is a fund implication and a cash implication of every expenditure. In other words, every expenditure has to be provided for first, then it has to be paid for. When provided for, it hits your profit. Provided profit. When it is paid, it hits your liquid. What a beautiful concept. Provision is out of profits. But then there is no such provision if it is a capital expenditure. Unless, of course, it's a payment which is made on a deferred basis. Fixed asset account debtor to sundry creditors. Sundry creditors to bank. You're providing. Strictly speaking, I'm not providing. But here, when you have to pay rent on 31st of March, you mentioned that. Rent paid account debtor to rent payable account for outstanding rent account to complete your matching concept, to accommodate for that in that accounting period. So that will hit your profits. Although paid in the next year, it hits your profits of that year. So bonus issue is also called capitalization of reserves. That is to say, it is free of cost as far as shareholders is concerned. But it is paid for as far as the company is concerned, but internally. You are using your existing free reserves. So I debit any of these reserves which are presently showing a credit balance. I credit equity share capital accounts. So a bonus issue is a distribution of shares for consideration other than cash. Rights issue, consideration being cash. This is consideration other than cash. And what is that consideration? Internal sources. Okay, so start with that. Bonus issue. A company may at any time issue shares to its existing shareholders in the form of fully paid up bonus shares. Fully paid up bonus shares. That's an interesting question which was asked to CS Inter some time back. CS executive. Can a company issue bonus shares such that the face value of the shares is 50 rupees? They are treated as paid up to the extent of 35 and the balance shareholders have to pay? No. Then that will be tantamount to a rights issue. This is why we always use the phrase issuing shares as bonus shares which are fully paid up shares, or issuing fully paid up shares as bonus shares. You cannot issue partly paid up shares as bonus shares. Okay, so a company may at any time issue shares as fully paid up bonus shares, by capitalizing or utilizing the existing free reserves that are otherwise available for distribution that are otherwise available for distribution as dividends. Otherwise available for distribution as dividends. Okay, full stop. A bonus issue is subject to. A bonus issue is subject to the following conditions. A bonus issue is subject to the following conditions. Okay, 1. 1 and 2 are those which we are familiar with. We have seen this occasionally every now and then. So I'm just quickly going to the first and second condition. 1. It shall be authorized by the articles. It shall be authorized by the articles. It shall be authorized by the articles of the company. In the same breath, what should be the second one? One is it shall be authorized by the articles of the company. What should be the second condition going by the same tune? Continue with the same tune. What should be the second? Yes. Good. 2. It shall be authorized by a special resolution. It shall be authorized by a special resolution providing for the specific terms and conditions. Providing for the specific terms and conditions. Okay, what will be those specific terms and conditions? What will be the price at which the company will record it? Which is the reserve to be debited? Within what time you will complete it? All those things. Again, if I were to ask you the question, when the articles is already authorizing it, why do you need a special resolution? The answer is, the articles is a general power. Articles is a general power of attorney. It will not give you the specificities for every time that corporate action is taken. The specific terms and conditions for that particular bonus issue must be approved by the members. And there are so many meanings behind it. This means that, or let me, before I speak out the truth, before I let the cat out of the bag, let me see if you can answer these two questions. I have a very important question. Again, it need not be completely company law, but let me see who can answer this. Bonus issue, I'm starting with a list of conditions. I came to the first condition, it shall be authorized by the articles, and we decided this is a general power. Then I said, this should be authorized by a special resolution. I said, that special resolution will give you the specifics or specificities. Now I come to a question. You should be able to read between the lines for all this. A company is making an issue of capital for the first time. Okay, I'll put it this way. A partnership firm, a partnership firm is becoming a company. You're familiar with this. You're experts on partnership accounts. Admission, retirement, change in profit sharing ratio, piecemeal distribution, Garner versus Murray, dissolution, conversion of a firm into a company. Now I'm referring to that. Partnership firm is converting into a company. Private company. Partnership firm has plenty of reserves, profits. Can the issue of shares be made out of the reserve? My question is this. Can the first issue of share capital by a company be a bonus issue? Of course, if it's a newly incorporated company, there's no question of existing reserves. So it's not possible. But then when a partnership firm or an LLP or an HUF, sole proprietor, which is very profitable, is converting into a company, can it make that issue of shares as a bonus issue? In other words, can the bonus issue be the first issue? No. The answer is no, because this is lacking. When you say bonus issue, every bonus issue requires a special resolution. Special resolution will be there only if you have members. So for a company to be newly incorporated, making the IPO as a bonus issue, ruled out, impossible. Even if it is any other form of business entity converting into a company, even if you're very profitable, that cannot be done. So the first issue cannot be a bonus issue. That was my first question. Now comes my second question. Bonus issue. Now I just want to show you that this concept of special resolution, articles authorization, I'm not just saying it monotonously. Some of you must have already got it. These are articles authorized. Special resolution. Automatically no. Now, to remove that misunderstanding, I'm coming to a question. Yendinum articles, Yendinum special, to correct that mistake. If you have that virus, I have to remove that virus. And I anticipate that virus is there in class. For a bonus issue, I said, special resolution is required. For a rights issue, I didn't say that. Does it mean you don't need a special resolution for a rights issue? Or why was it specifically not provided? Or, indirectly the question is, do you need a special resolution for a rights issue? Similarly, do you need an articles authorization for a rights issue? Why I didn't say? I didn't obey, I didn't forget it. Don't worry. Rights issue, authorization by articles, authorization by special resolution, missing. I didn't see it. That is because it is ordinary corporate action. There is no choice, it's mandatory. Section 62 is a self-fulfilling legislation by itself. When Section 62 says something, your articles can't say something otherwise. The articles cannot override the Companies Act. But in a bonus issue, you have options. Which reserve to debit? What will you take as the value? Articles need not authorize a rights issue, just like the articles need not authorize a capital issue by a company. Will the articles of a company say the company may issue capital at any time? It's your right, you have an authorized capital. That can be issued at any time. Articles power venda. Again, it is very, very similar to our concept of business necessity versus object of a company. Where you have multiple options coming into picture. That is where the articles is. Section 62 is self-contained. Everything that a company must do is there in Section 62. So there's nothing like articles must authorize it, or you need an authorization by a special resolution. No. The board of directors will decide, board resolution is sufficient. Be very careful. Don't take this articles authorization, special resolution authorization monotonously like a robo. So here, I can debit any reserve. I can give any value for the bonus share. In the case of vice shares, it is paid for. So there's a value. In the bonus shares, of course, you will record a bonus issue only at book value. For example, if a company has shares of face value of 50 rupees each or 10 rupees each, bonus issue will be only at that. If there is a premium, that will also have to be funded by the reserves there. So you will have a very peculiar situation. Reserve fund account debtor to share capital account to securities premium account. Why do you do that? So there are various options here in the bonus issue. So that is why you have an authorization by the article, authorization by the special resolution, which you will not find in the rights issue. So in the case of a bonus issue, authorization by the articles, authorization by the special resolution, something like we have seen it, redemption of preference shares, buyback of securities. Now, the third one, condition number 3, the bonus issue shall be completed the bonus issue shall be completed within 12 months. That's too long a time actually. We have seen this even for buyback. A buyback should be completed within 12 months of the special resolution. Add that here. A bonus issue must be completed within 12 months of passing the special resolution. 12 months of passing the resolution. Okay, that's condition number 3. Condition number 4. Again, self-explanatory, you have seen this before. Number 4, a listed company making a bonus issue shall comply with the SEBI ICDR regulations also. You know how to write that, SEBI and within brackets ICDR. shall comply with the SEBI ICDR regulations, 2009. Also, so that's for a listed company. Okay, authorized by the articles, authorized by special resolution, completed within 12 months. If it's a listed company, you need to comply with the SEBI ICDR regulations also. Number 5, the reserves which are otherwise available, the reserves which are otherwise available for distribution as dividends, the reserves which are otherwise available for distribution as dividends or the CRR account only may be utilized or capitalized for the bonus issue. Okay, now there is a condition coming up as the 6th one, the last condition, which is very mysterious. It's a mysterious condition. I just put it on top of here, assuming that you have got this. What are the reserves that can be utilized for the bonus issue? Those which are otherwise available for distribution as dividends, plus the CRR, the capital redemption reserve account. Only those can be used for making an issue bonuses. Only those can be used for debiting or the capitalization or the utilization. Now, there is a condition which appears to be utter nonsense. The 6th condition, all these conditions are self-explanatory, understandable, very important, very pertinent, very relevant. There is a 6th condition. I'm going to bring it up. That no company shall issue bonus shares in lieu of dividends. ICDR loan, Companies Act loan. No company shall issue bonus shares in lieu of dividends. Believe me, every company actually does that. What does this provision indirectly mean? ഒരു വർഷത്തില് ഡിവിഡൻഡ് കൊടുക്കാൻ പറ്റാത്തത് കൊണ്ട് ഒരു ബോണസ് ഇഷ്യൂ ചെയ്യുക. For the benefit of Harshita here, just because I am not able to pay dividends, I make a bonus issue, not allowed. But believe me, every company actually does that. A company has been regular, let us say in the past 6 years, 4 years dividend have been paid. In the 7th year, to keep the shareholders happy, since the company doesn't have the funds, it has the money, but it doesn't have the funds. So it makes a bonus issue. And the other way around. It has the funds, but not the money. Make a bonus issue. After all, there's no cash involved. See, every time the company makes a bonus issue, we must remember something. Its dividend liability thereafter is going to increase. A company's present share capital is 1 crore, paid up capital. You're going to make a, let us say, 25% of this as a bonus issue, is going to become 1 crore 25 lakhs. So hereafter, whenever the company distributes, whenever the company plans to pay dividend next, which you can't keep deferring indefinitely. Whenever your duty to pay dividend arises next, dividend will be more. You will be increasing your dividend burden hereafter. So even if you are issuing bonus shares today because you're not distributing dividend, the future dividend liability will gear up. So you have to be a little prudent in making issue bonus shares. Now the section says, the Act says, the ICDR says, no company shall issue bonus shares in lieu of dividends. But every company does that. Not only every company does that. Financial management as a subject itself talks of two types of dividend. Cash dividend and share dividend. So when Companies Act or ICDR puts this provision, there's nobody who's obeying it. Management accounting uses the word share dividend. Then what is the use of this? You should never make a provision which is practical, which is impracticable to follow up. You should not make a provision which is difficult to ensure compliance. So when everybody does that, what's the relevance of this? And it continues to be act. No company shall issue bonus shares in lieu of dividends. Utter nonsense. Because everybody is doing it. I was doing the same thing in Chennai during a class in my last session. I came to this point and stopped. You should never make a provision which is difficult to ensure compliance, difficult to monitor. So this condition is utter nonsense. I came to that point and stopped. I could see the sparkle in a girl's eye, in a student's eye. She was coming up with a question. She was bubbling up. When I said this and stopped, that this condition is utter nonsense. I asked her, yes, what is it? I was taking a class in Chennai, but that girl was a Keralite. She told me, sir, ഇതിന് പകരം ആ provision മാറ്റിക്കൂടെ? You don't want a company to issue bonus shares, even is defaulting on dividends. Instead of that, why don't you just change the condition and say, a company shall make a bonus issue only if it is regular with dividends. I told her, സമ്മതിച്ചു. ഇതെന്താ എനിക്ക് മുമ്പ് തോന്നാഞ്ഞത്? Fantastic. Just come to me during the lunch break. We will send a mail to the Ministry of Company Affairs. Let us see how they answer this. I said, this is a beautiful suggestion. I hadn't thought of this. And if I put the mail from my personal professional ID, when a chartered accountant talks, people will listen. I assure you of a response within a quick time. And she got excited. Yes, sir, we'll send. I told her, I will word it. I will word the mail. But sit with me, see how I send the mail, see how the response comes. During the lunchtime, we sent a mail to the Ministry of Company Affairs from my professional ID as a chartered accountant. This is what the provision is. This is the objective of the provision. But that objective is not being achieved. So why don't we change the provision to this? So our objection was to the provision that no company shall make an issue of bonus shares in lieu of dividends. Believe it or not, the response came in 24 hours. And when the response came, Both of us read it together and we couldn't stop laughing for 2 days, seeing those points. By the next day's lunch break, the reply had come from Minister Khan. Respected sir, excellent suggestion. But we can't implement it for the following reason. Follow the reason carefully. No company shall issue bonus shares in lieu of dividends. The mail said, we ourselves are confused about which dividends are we referring to. Is it past dividends or current dividends? I'll give you two situations. In the past 6 years, 5 years consistently I paid dividend every year. 8.5%, 9%, 9.5%, 8.25%, 9.2%. Consistently in the last 5 years. 6th year, I don't have the money to pay dividend. I issue bonus shares. Is that what you are prohibiting? Or what is the other possibility? In the last 3-4 years itself, I am defaulted. There is no dividend paid in the last 7 years. Now I am issuing bonus shares. Is it that which you are preventing? So when you say dividends, are you referring to past dividend or current dividend? That's a confusion. And they told me, we will just confirm that first, then we will see amending the project. Till now it is not amended. So, when you say no company shall issue bonus shares in lieu of dividends, which dividends are you referring to? Because in the first case, you will agree with me, there's nothing wrong. 25 years consistently this company has paid dividend, maybe 1 or 2 years as a default. 26th year, it's not able to, it decides to make a bonus issue. I don't think that is objectionable, that is fine. But if a company is errant on dividends, so it should be past dividends. But then you may have to amend the provision accordingly. And that amendment will make it complicated. That's why perhaps they are not doing it. So which dividends are we referring to? Is a problem. While taking a final class, I mentioned this. Again, I came to this point and stopped. And there was a final student who made a recommendation. That also looks sensible. He said, sir, either past dividend or current dividend or Allah, and declared dividend. Dividend declare ചെയ്തിട്ട് അത് കൊടുക്കാൻ പറ്റാത്തത് കൊണ്ട് ബോണസ് ഇഷ്യൂ ചെയ്യാം എന്നാൽ അത് മെൻഷൻ ചെയ്യണം. Sensible, very sensible. But then I don't think any company will do that. Board resolution passed, special resolution passed. In the special resolution, you have to give an explanatory statement how you are going to fund it. Declared dividend in the pagaram bonus issue ചെയ്യാൻ പാടില്ല എന്നാണ് section ഉദ്ദേശിച്ചത്. So the word dividend leads to plenty of confusion. When you say no company shall issue bonus shares with your dividend, it will be past dividend, it will be current dividend, it will be declared dividend. Now some of you here can add to the confusion even more, and I am welcome to that. I give you 3 possibilities. There could be other confusions which I am not able to think of as of now. Ultimately, that's a stupid provision. 1, because you can't monitor it. Number 2, although the objective is good, the manifestation went out of order. But the condition continues. It continues the Companies Act, it continues the ICDR regulations. It is there still worded for so long, in spite of the fact that it is a numb provision. A numb part of the body is a part where you don't get feelings. So this is a number provision where there are no feelings, no sentiments, no emotions. And you can't even see whether it's working. I want somebody here to have the guts to write in the exam if this question is asked. Write down that sixth condition and then say, nonsense. This condition is a nonsense. Don't do that. I can say that. You can't say that. Anyway, so this is a condition which is difficult to monitor. It is difficult to word it. But the intentions are clear. I can understand the intention of the parliament behind this. We don't want a company to keep the shareholders happy when it has defaulted on dividends for a long time. Number one, because it is unfair. Number two, because it is imprudent. Prudence goes for a toss then. Conservatism goes for a toss. We are just trying to ask a company to realize that if you make a bonus issue, your future dividend liability is going to increase. Without thinking of that possibility, if a company makes a bonus issue, that should not be allowed. So we are making a company be prudent, just like our provision of, transfer. When you are utilizing existing free reserves for redeeming preferred share capital, buying back securities, transfer an amount equal to face value to the capital redemption reserve account. That's a prudence actually. That is a liquidity, that's a safety buffer, cushion for the creditors. Like that, the intention of this cushion is clear, but it is not manifest in the section. So there is a spelling mistake with this provision. There's a grammatical error, there's a corporate grammar which has gone somewhere awry. Okay, so put on the sixth condition nevertheless. Condition number 6, no company shall make a bonus issue in lieu of dividends. LIE. In lieu of means, I told you before, instead of. No company shall make a bonus issue in lieu of dividends. Okay, so it's a very, very simple question to answer. The question is, distinguish between a rights issue and a bonus issue. Lot of differences. Rights issue is paid for, bonus issue is free of cost. Rights issue does not require specific articles or special resolution authorization. Whereas for a bonus issue, since there are various options available, you need to be specific. A rights issue is open only for 15 to 30 days. Whereas a bonus issue shall be completed within 12 months. There's no question of a prospectus in case of a bonus issue. There's no question of not receiving minimum support because it is received by the members, after all, without making a payment. So it only gets credited to their accounts. It only gets credited to their demat accounts. Now, this is one question which I have never been able to get an answer to. I'm asking you a question, not because I want to test you, but it's a question for which honestly even I don't know the answer. Let us see who can come out with an answer. Not immediately, you can refer, you can ask different professionals. Just like a rights issue may be renounced or rejected, can a bonus issue be rejected or renounced? Honestly, I have not got an answer to this. I am also searching for the answer. I have tapped in multiple potential avenues. I have not got the answer. See if you can help me. Just like a rights issue is renounced or rejected, can a bonus issue be renounced or rejected by a shareholder? Looking at it from a common sense point of view, it looks like it should be allowed. But I don't think I don't think it is legal or right. I don't think it is ethical to allow a shareholder to renounce a bonus issue. And besides, common sense doesn't approve it because it is out of free reserves. In a rights issue, when you renounce, the renouncee pays for it. In a renunciation of rights, there's a renouncer and a renouncee. The renouncee pays for it. Here, there is no method of tapping consideration from the renouncee if it were permissible. Now, this problem arises because the act is silent on it. It is just an out-of-the-world thought. But then try and see if you can help me. Can a bonus issue be renounced? And I don't want just a yes or no. I want a justification for it. Why do you say yes? Or why do you say no? So I try and see if you can get an answer. I'm being very frank with you, which I should not. That I myself don't know the answer. I shouldn't ask you a question for which I don't have the answer. But then this is something which will challenge your imagination. Let us see. I have thought of it on different lines. I have referred to multiple books or literature on this, but not being able to get a satisfactory reply. There are various yeses and nos with justifications. But let's see if you can give me the answer. So that's a bonus issue. Now, as I told you before, whether it's a rights issue or a bonus issue, the credit goes to equity share capital. Credit to equity share capital. What is debited is the difference. In the rights issue, cash or bank account is debited because they pay for it. Whoever it is will pay for it. Either the existing shareholder or his renouncee will pay for it. But in the bonus issue, it is a reserve which is getting debited. So a free reserve, a liquid reserve is getting a promotion in the balance sheet. It moves from the head, reserves and surplus to share capital. This issue is also called in accounting language as capitalization of reserves. Why don't you write down the next slide? Note. In accounting terminology, an issue of bonus shares is called capitalization of reserves. It's called capitalization of reserves. Since the funding in connection with the issue is from internal sources. So I want you to imagine and understand what happens in a bonus issue from the shareholder's point of view, from the company's point of view. From the shareholder's point of view, I have 50 shares, I get 20 shares credited to my account if they are the demat form, without having to make any additional investment. So my capital holding goes up. As far as the company is concerned, the increase in the capital is out of the reserves. Again, needless to say, all the other conditions to the extent applicable will apply here. For example, minimum subscription, not a big deal. or it's not relevant at all. You don't have to appoint any lead manager. You don't have to keep the issue open for an option because the act is silent on acceptance, rejection, renunciation. But the act provides for a period of 12 months within which this should be completed. The process must be completed. 12 months is too long. I don't think I will need even 12 days for this, especially if the shares are dematerialized. But at the same time, a return of allotment must be made. So after the process is complete, after the share certificates have been made, printed, issued to the shareholders, register of members you will have to update, and you will have to file a return of allotment within 30 days, just like in the other cases. Whether it's an IPO, an FPO, a rights issue, a sweat equity issue, or ESOPs issue, return of allotment must give all the details about it and file with the registrar within a period of 30 days. Okay, so that's the second type of a special capital issue. Let me just go back. All India Radio bringing you the news. We are dealing with different types of special issues of capital. The first was rights issue. The second was a bonus issue. The third is the sweat equity. Just put it down next. Number 3, sweat equity shares. SWEAT, sweat equity shares. I don't want to start this afresh. Shall we stop with that for now and continue the next time? But then when we continue the next class, which is I think scheduled for 15, we will revise and compare the rights issue and the bonus issue with sweat equity and ESOPs. So there are 2 more special types of issues coming up. One is again for cash and one is for consideration other than cash. Rights issue, bonus issue, sweat equity, and ESOPs. So once these 4 special types of capital issue are completed, I will be dealing with dematerialization. What exactly is the process? What is done? What happens in a dematerialization or a rematerialization? Then I will be going in for the depository receipts, GDRs, ADRs. For that, you need to understand what is dematerialization. And then we can come to the very important aspect towards the end of the chapter on alteration of share capital and reduction of share capital. Right? So we'll wind up with that for this time. Continue in the next class. Thank you.